We're going to jump right into this. Fire away some questions.
Okay.
There's a lot of conversation right now with where's the rates going, what's the market's doing. And we just wanted to kind of maybe pepper you with a few questions. Love your insight if you don't mind sharing with us.
That's perfect, Chuck. I'd love to answer any questions you have.
Awesome. So let's just start this off. There's a lot of volatility that we saw last year with the mortgage interest rates. They pretty rapidly rose. Kind of what are you seeing right now? What's the volatility looking like in the market?
Chuck, great question. It's still very volatile, and if you're watching the news, the biggest thing to watch for right now is all about inflation, right?
Okay.
And what's the Fed going to do to fight inflation? So taking a step back, so November of 2021, everyone was talking about the 2% rates. Last year, they went as high as 7%. And then they've really calmed down this year, and where we've been seeing rates is anywhere in the high 5s to low 6s and kind of bouncing back and forth. But for the most recent rate news, so 2 Thursdays ago, the Fed met and said they were going to raise the Fed's funds rate by 0.25%. Big clarification there. The Fed's funds rate is not the interest rate.
I was going to ask you that. So, are they tied together?
They are not. So when you see that in the news, that doesn't mean the mortgage interest rates go up. So that's the money banks borrow money from each other overnight. But the reason the Fed's raising interest rates right now is to fight inflation. So last Thursday was a 0.25% raise, which has been the smallest amount we've had in all these raises. The market really liked it Thursday. Rates were starting to trend down a little bit. Well, Friday, the jobs report hit. More jobs than they were expecting, meaning the economy's not really going the direction the Fed wants it to. And since then, we've seen rates tick back up. So right now, you're probably, depending on your scenario, somewhere in the low 6s, 6 to 6.25, 6.375. And it's going to be all about what happens in the economy. The CPI data came out yesterday higher than expected, and the market didn't like that. So 3 times before, we saw a slow trend, and what Wall Street and everyone's been hoping is, hey, everything the Fed's done up until now has worked, and inflation's going down. The numbers are not supporting that data right now. So as we're watching everything, we need to see inflation come down, the job reporting coming down. Like, if you think about it, it's kind of crazy, but they have to somewhat cripple the economy right now to fight inflation, right?
Yeah, I mean, that's kind of what I hear, is that as long as the economy continues to be somewhat strong, we're going to continue to be faced with higher interest rates on the mortgage side of it.
We are.
We need kind of the economy to come to a halt, not a halt, but slow down the pace that it's been to kind of see a little bit more stabilization. Is that a layman's kind of fair
It
summary?
is, right? In my world, bad news in the economy usually means better rates. Good news doesn't, because that's the way it works with stocks and bonds. But right now, from an interest rate perspective, if I had to guess, we're going to see rates continue to go between the high 5s and low to mid 6s most of this year. Once you do consistently see inflation coming down and the economy doing what the Fed wants it to do, I think you'll see rates drop. So no one can guarantee it, but I would expect going into next year is when we're going to see stuff start to trend back in the other direction.
So people kind of hang their hat on what the Fed does, but it's much more complicated than that.
It's much more complicated than that, and it comes down to inflation right now. Because if you think about it, if there's a mortgage, it's a 30-year note they're getting paid on. So if inflation's high, the money's worth less. So interest rates are going to be higher to account for that. So that's what we're looking at there.